The wellness, fitness, and personal care industry, comprising gyms, salons, and yoga centers, is experiencing a massive regulatory shift. While the reduction of the GST rate to a flat 5% sounds like a welcome relief for consumers, it has introduced complex compliance challenges for businesses, particularly regarding input tax credit and place of supply determination. If you are running a gym chain, a premium salon, or a wellness retreat, applying the wrong tax type can lead to severe department notices, interest liabilities, and irreversible ITC blockage. In today's video, we will dissect the exact tax rates, the ITC impact, and the critical place of supply provisions under sections 12 and 13 of the IGST Act that you must know. Let's first look at the rate structure. The wellness sector has transitioned to a lower rate restricted credit regime from 18% to 5% without ITC. While a 5% rate makes these services cheaper for retail clients, the catch is the absolute restriction on input tax credit. Under this regime, these businesses cannot claim ITC on their inputs, input services, or capital goods. This means no ITC on capital goods, no ITC on input services, and common ITC reversal. Now let's address the core legal issue. Where is the place of supply? Many practitioners make the mistake of applying the general B2B rule under section 12 subsection 2 when a corporate client registers for a gym membership or books a bulk salon session for its employees. They assume that if the corporate client is registered in Delhi and the salon is in Mumbai, they can charge IGST. This is a major technical error. For personal care, fitness, and grooming, the law provides a specific overriding provision under section 12 subsection 4 of the IGST Act. The place of supply of restaurant and catering services, personal grooming, fitness, beauty treatment, health service including cosmetic and plastic surgery shall be the location where the services are actually performed. Let's look at a practical case study. Supplier is a premium salon in Mumbai, Maharashtra, who is registered in B2B. Recipient is a corporate registered in Bengaluru, Karnataka. Service is grooming and styling services provided to employees at the Mumbai salon. In this case, even though the recipient is registered in Karnataka, the services are performed in Maharashtra. Under section 12 subsection 4, accordingly the place of supply is Maharashtra. CGST and SGST of the Maharashtra state will be charged and not IGST. The Karnataka corporate client will not be able to claim ITC on this component because it is a distinct state. Now what happens if an international tourist visits your yoga center or salon in India? Or what if an Indian wellness expert travels abroad to provide personal training? In cross-border scenarios, we must refer to section 13 of the IGST Act. Specifically, section 13 subsection 3 subclause B governs services supplied to an individual. The place of supply of services supplied to an individual represented either as the recipient of services or a person acting on behalf of the recipient which require the physical presence of the recipient with the supplier shall be the location where the services are actually performed. Just like the domestic rule, if a foreign national gets a haircut at a salon in Delhi or attends a 10-day yoga retreat in Rishikesh, the services require their physical presence. Therefore, the POS is the location of actual performance, that is India. Even though the recipient is located outside India and payment may be received in convertible foreign exchange, this cannot be treated as an export or service because the place of supply is within the taxable territory of India. Consequently, local GST, that is CGST, SGST, or IGST depending on registration, must be levied. To ensure your invoices are fully compliant, keep these three best practices in mind. Mandatory POS disclosure, no IGST on B2B local performance, and meticulous ITC apportionment. If your business model includes selling taxable merchandise like yoga mats or beauty products at 18% with ITC, along with fitness services at 5% without ITC, maintain separate books of accounts to prevent department disputes over ITC allocation. If you find this technical breakdown helpful, please hit the like button, share this video with your fellow tax practitioners, professionals, and taxpayers, and subscribe to the channel for more deep dives into GST law.